Kia ora koutou, welcome to Face to Face, and we've got Bernard Hickey with us again, talking about how Reserve Banks can manage this real cocktail that we talked about in the last video of low interest rates, stagnant growth, and because of these low interest rates, all we're seeing is asset prices, like property in particular, go through the roof. And instead of stimulating the actual economy, which is what Reserve Banks want to do, right?
That's right. They want to cut interest rates to get the economy going again so it can push up inflation and reduce unemployment. But the problem is they're cutting interest rates and everyone's just putting it into more three-bedroom brick and tiles in Pakuranga. So the Reserve Bank is having to think about new ways to be able to cut interest rates, but at the same time reduce some of this leverage, particularly into property prices.
So by leverage, you mean the amount that you can borrow to put into property. So they're trying to force people to stump up more of the cash themselves.
That's right. Yeah. Before the first round of loan-to-value ratio restrictions that the Reserve Bank brought in 2013, you really could rock up to a bank and say, could I borrow 95% of the property? And the bank would say, yeah, go for it. Particularly as interest rates fell, it made it a lot easier to afford these big loans. And the problem the Reserve Bank saw was that not only was it frustrating their attempts to stimulate the real economy, but also they saw a risk that if there was too many of these 95% mortgages, then if there was a downturn in the housing market, then the banks could be caught out because people would be underwater, as we saw in the United States and in Ireland and Spain and places like that. So the risk for the Reserve Bank is that it needed to find a way to reduce that leverage. And it started off by limiting loan-to-value ratios. And secondly, it is looking at limiting debt-to-income multiples.
Right. So loan-to-value ratios at the moment, they're at, you have to have 20% of the cash, is that right? But it's more for investors in Auckland?
That's right. The first round said you had to stump up 20% for yourself, and it was regardless of whether you're a landlord or a first home buyer, whether you're in Timbuktu or Gore, it applied to everyone. And it was sort of painful for a bunch of people in Gore for a start and first home buyers. Yeah. But the second round, which was brought in,
first home buyers had to get more deposit to be able to afford a home. Yeah,
that's right. And essentially it enabled particularly landlords to get in there and win in the contest because they typically had more equity that they'd built up in their properties over the years.
Because their properties had already gone up by a lot of money, right?
That's right. So in the second round of LVR controls, the Reserve Bank said, okay, we've got a particular issue here. We need to slow down these Auckland landlords who are just going gangbusters. So they changed the limit. So instead of having to put up 20%, you have to put up 30% if you're a landlord in Auckland. And that seemed to work for about 2 months to slow down the property market. And now the Reserve Bank is looking at further controls, potentially reducing that 70% rule to maybe 50 or 60% in Auckland, right, or maybe extending that out from Auckland landlords to landlords all around the country.
Because we're seeing Auckland landlords just rock on down to Hamilton with their cash and buy there.
Exactly. In fact, in May, we saw that 2/3 of the new lending in May was done by Auckland landlords. This is across the country. So not only are they buying other houses in Auckland, but they're going down to Hamilton or Tauranga or Wellington and buying up rental properties because they've got lots of equity and they can jump in there and they're not limited to 30% like they are in Auckland. So the Reserve Bank's looking at that, and the Reserve Bank's also looking at limiting debt-to-income multiples. So at the moment, you can go to a bank and say, well, I earn 50K. It doesn't really matter how much you're going to lend me. And some banks are lending 6, 7, 8 times income. And in other countries, the way that they've addressed...
It's up to 10 in Auckland, isn't it?
That's right,
some places,
yeah. And in other countries, particularly Britain and Ireland, they've used debt-to-income multiple controls to do this business of trying to reduce the leverage. So in Britain, it's 4.5 times income. You can't borrow more than 4.5 times income.
That would kill things.
That's right. In Ireland, it's 3.5 times.
Wow, okay.
And it turns out in New Zealand, we've got a lot of leverage. So there was an interesting chart the Reserve Bank put out, which we can show here, which shows that more than 60% of landlords in New Zealand have borrowed more than 6 times income.
Wow.
So if the Reserve Bank was to put the threshold at 6, let's say, we don't know they will, but let's say they do it at 6, then that would pretty much stop all lending to to new landlords. And that's one of the things that we'll watch for over the next 6 to 12 months.
And how do they define income in that respect? Because those landlords have a lot of money presumably coming in from renting out their houses. Is that included in their income as well as jobs they do?
Well, that's the really tricky thing. And the Reserve Bank hasn't made a decision yet about how to assess the income. Is it the income of the property owner? So let's say you're a dentist or a doctor and you've got 4 or 5 rental properties. Is it your income as a doctor that is the thing that determines the debt to income multiple? Or is it the rent on the property, which might be actually quite a low number? Because remember, a lot of people are buying these rental properties at yields of 2-3% or so.
Yeah, yeah.
And that's the risk here, is that the Reserve Bank, for the property market's point of view, not for the first home buyer's point of view, but the Reserve Bank could say, okay, we're going to limit it to, let's say, 6 times the rental income on that property, and that would wipe out that market completely, because there's just no way that it could be done with the very low yields that we've got at the moment.
But even if you're doing it on total income, including your wages and salaries, it's going to put a real limit on the amount of rental properties that one person could own, no matter how much they earn.
That's right. I've spoken to some mortgage brokers who say that if the Reserve Bank was to put in a limit of, let's say, 6 times income, even if it was the income of the owners, not of the properties themselves, that would shut down the market overnight.
So that could actually be a good thing for first home buyers?
Well, it means that they could go to an auction and not have to compete with rental properties, property owners. That's true. But of course, some people are worried, and I bet there's a few politicians who are worried that if you take the rental property buyers out of the market, that's going to depress the market, and you could see prices fall.
Prices could fall, get a crash going.
Mm.
Okay, so are there what other tools does the Reserve Bank have in the box, as it were, apart from loan to value and debt to income ratios?
Well, they could increase the amount of capital that banks have to hold. So remember, whenever a bank writes a loan, typically it has to put aside 7 or 8% of money into its reserves to make sure that if the loan went bad, it could be okay and safe as a bank. And New Zealand banks have a relatively high amount of capital they put aside, anywhere from 8 to 15%, depending on which bank they are. And the Reserve Bank could say to banks, hey, you need to put aside an extra layer of capital for all the mortgages that you've got, let's say in Auckland, where the risk is. Now, the Reserve Bank hasn't talked too much about using this, what they call a sectoral weighting tool, which would put a capital overlay onto a particular type of lending that the banks do. But that's one of the options they could use, and they already have that in their toolkit, their so-called macro-prudential toolkit, which the Reserve Bank Governor has agreed with the Finance Minister.
But they're reluctant to use the macro-prudential tools because they see that as more about risk and less about controlling the housing market.
Yeah, that's the argument they put, that the reason we're putting in LVR controls and debt-to-income multiple controls is because we want to safeguard the stability of the financial system. However, they also at the same time talk about the risks that a housing market boom could spill over into inflation. Although, to be frank, they don't have too much to worry about with inflation right now. It's 0.4%, the annual rate, and they need to get inflation back up to around 2%. It's been under 2% for nearly 4 years, so there's an incredible amount of pressure on the Reserve Bank to cut the official cash rate, but do it in a way that keeps the financial system stable. And that's why they're so keen to use these other tools like LVRs, like debt to income multiples, and potentially sectoral capital overlays.
And so there hasn't been much conversation about the other tools like sectoral capital overlays. Likelihood?
Well, I think it's possible. The Reserve Bank is doing a review of capital requirements at the moment. I think it's potentially a year away or so rather than something immediate. I think the first thing they'll look to do is loan to value ratio controls, because they've already got those systems in place and they could essentially turn the dial. The next thing is the debt to income multiples. But there is a chance the Reserve Bank could use the capital requirements as a way to reduce some of the leverage in the system.
So what's your pick? In 6 months, a year's time, could there be some real skids coming in on the housing market? Or
just depends how hard the Reserve Bank wants to pull on the brake, if you like. If they choose to go down the debt to income multiple route and let's say put in place a multiple of, let's say even if it was 8 times the income on the property, that would really slow down the market, particularly for rental property buyers who are buying up to 50% of the properties in some parts of the country, certainly in Auckland, parts of Hamilton, Tauranga, And also when you look at how much money is being pumped into the market, it's those rental property investors who are going in there at the moment, because it's pretty much a free kick. Remember, they're not paying any capital gains tax at the moment, particularly if they're not rolling things within 2 years. And of course they can see the same thing we can all see, which is that interest rates just keep on falling all around the world. All around the world they're at zero. We've still got 225 basis points to go if we get down there. And so if you're a rental property investor, you see free kick, a big free kick on capital gains that are tax-free, and the potential for lower interest rates to fuel that.
And last question for you. People talk a lot about foreign buyers. How much of an issue do you think it is?
Short answer is we don't really know, because the government has only just started collecting the data, and the first batch of data that we got was very inconclusive. You could set the number at somewhere between 3% and 40%, so it's unreliable. We're going to have to wait for another 6 months, 12 months before we'll have a much better idea of how much foreign buying there is. Lots of anecdotal evidence in Auckland that it's a particular issue. Hard to know whether the buyer is an actual non-resident or whether they happen to be a student or here on a temporary visa or working here. You just don't know. And it's going to take a long time before we actually know a lot more. It's a pity it's taken so long to collect the data. It should have been done years and years ago.
So thanks, Bernard. So we face an interesting year in the next year with the property market and how the Reserve Bank tries to reel in the property market given that interest rates are so low. Some interesting times ahead. Thanks, Bernard.
Cheers.